We're going to explore conservative investing for those that are not risk takers, or if you're close to retirement or you have already retired. So stay tuned for the full episode. Thank you for watching. This is Richard with Wisdom Investor. We're going to take a look at conservative investing. The stock market is at all-time highs right now, but despite that, many folks are not fully invested in the markets. Now, there's various reasons for that. Some people, it may be due to risk tolerance. Others, it may be due to afraid to lose their money. So we're going to look at some strategies here to help you develop a conservative plan of investing. So what we're going to look at here today is how we can get an appreciation of 5 to 7% with a minimal downside risk. We'll also look at how to avoid a large drawdown of cash reserves. Also, you'll be able to develop income from dividends and have a low percent of money invested in the stock market. Right now, if your money is sitting in a savings account, you're earning less than 1% on your money. You're going to want to grow your money to keep it up with inflation. So let's take a look at what's going on with the latest on inflation. Consumer prices jumped 5% in May, fastest pace since the summer of 2008. So $1,000 that you had last year is not going to buy the same amount of goods as it would this year due to inflation. We're going to take a look at 3 very conservative investment vehicles here. Keep in mind our goal is to get a return of 5 to 7% to the upside and keep our drawdown to the downside as small as possible, less than 3% in most cases. Now, if you want absolutely no fluctuation in your principal, then using a savings account is about the only way you're going to do that. I ran across this survey from Schroders, an investment management company, and here's what they had to say. Both retired and non-retired respondents to the survey all agreed to these 5 points here. The first 2 were healthcare related concerns. Now, the third one here says a major market downturn significantly reducing my assets was a major concern with retirement. 72 to 81% on that. The next area was not being able to afford lifestyle of desire. And then the 5th one was not knowing how to best generate income and or draw down my assets. So according to that survey, people are concerned with income in retirement and also not getting caught up in a stock market crash. So we went on a search. Here's the criteria that we're looking for in the funds that we're suggesting. Number 1, equity income fund with low downside risk. Equity income fund with steady move upward without major fluctuations. We're not looking for aggressive funds that move up and then once they peak, they crash back down. We're looking for funds that have a low percentage of stocks to bonds, say 25% stocks, 75% bonds or fixed income, or 40% stocks and 60% bonds or fixed income. In the bond portfolio, we're looking for funds that aren't loaded with junk bonds with high risk. Also, number 5, not heavily invested in volatile technology stocks. And number 6, a low beta or low stock market volatility potential. So I found 3 funds that met our criteria. The first one here is American Century One Choice, symbols AONIX. It's 26% stocks, 74% bonds. American Century Fund, last 3 years has averaged 7% return, last 5 years 6% return, meets our criteria. It's only had 2 years where it's had a loss. 2018 was the largest at 2.49%. The next fund that met our criteria is Vanguard Wealthy Income, VWINX, 40% stocks, 60% bonds. Vanguard Wealthy 3-year return 9.76%, 5-year return 7.76, meets our criteria. The last 10 years only had 1 down year of minus 2.57%. The third fund we're looking at is Chartwell Income Fund, BERIX, 23% stocks, 77% bonds. The Chartwell Fund, last 3 years up 5.69, the last 5 years up 5.32, meets our criteria, and has had 2 down years in the last 10 a minus 3.3 in 2015, and a minus 0.82 in 2018. The Vanguard Wealthy Income Fund had the best credit rating on the bond portfolio. Now this is the credit rating of the bonds for the Vanguard Wealthy Fund. You can see that the majority are in the AAA, AA, single A, and the BB category, and they have practically zero in junk bonds. There's a small amount of junk bonds in the American Century Fund and a small amount in the Chartwell Income Fund, but nothing that will take away from the quality of these two funds. As far as the beta and the volatility, all three of these funds have a beta much less than the S&P 500 and have less volatility, less market fluctuation. Now we're looking at a one-year chart for the American Century Fund. As I mentioned earlier, if you want zero fluctuation, you'd want to get a certificate deposit at the bank. Now this goes back 1 year to July of 2020. In October of 2020, you can see there was some fluctuation to the downside. From top to bottom in this particular situation, it moved 3% and then it proceeded back higher. So you're going to get some fluctuation, but it's pretty much within the parameters that we set and what we were looking for in a good low-risk conservative fund. Here's the Vanguard Wealthy Fund. Again, that same time period, October 2020 to November 2020, and this moved down. It was about a 3% move, and then things started moving back higher. The Chartwell Fund during that same time period had a move of about 1% to the downside. As a conservative investor, if I was to get started in one of these funds, I would not put all of my money right here at the top. If you were going to invest, say, 10% of your funds and just get started, that would be fine. Ideally, I'd like to see a pullback of maybe 2 to 3% before I get started. I'm using this as an example here, but I'm going back to November of 2020. If I was to make an initial investment back in November of 2020, what if this would have kept moving down? I'm going to give this about a 3% room to move at the time I make my investment. If it goes past that, I'm going to exit the fund on my initial investment. Let's say I had $50,000 and I'm going to invest 10% of it. I would invest $5,000 at this point here. And then I would do another 5, say every 3 to 4 weeks. Or if there was a point where the market dipped. As the market moves up, I would use a trailing stop of about 3 to 4%. That way you could protect your gains. So if we moved up here higher, all the way up here, and then all of a sudden we had a 10% drop, and I'm just making that up for example, I would have been out of it at 3 or 4%, my stop, protecting my profits. Now here's a look at the Chartwell Fund going back to the pandemic. And you can see how it went down. Everything went down. Stocks and bonds all went down. It was a very unusual situation. I don't expect having another situation like that again. But by having this trailing stop that moved up, we would have protected our profits. We would have been out of the market as this dipped down. What happens is when a stock or a fund moves down and it gets really heated, people sell out down at the bottom. If you're going to sell up at the top and take your profits. So to protect your retirement funds, you want to have a trailing stop. As this fund moves up, your stop moves up. You can set a stop on most software programs. If you can't set a stop, then have a mental stop when you want to be out to protect your retirement profits. So bank savers are pretty much forced to use the stock market in one way or the other because interest rates are so low. About the only way you can get a decent return is you've got to be in the stock market. But many people don't want to be in the stock market because they don't want to take the risk. So we looked at some funds here that are low risk, conservative, that won't destroy your retirement funds if you pay attention. Always have stops in there to protect your profits, and you won't lose your retirement funds. So I want to thank you for watching. Pass this video on to someone else. If you like the content, Please stay tuned for our next update.